Hello, everyone. I'm Brian Daingerfield, the co-head of G10 FX Strategy at NatWest Markets, filling in for John Briggs. Russia's invasion of Ukraine continues to be the dominant driver of global markets. That being said, market pricing recently has shown some signs of cautious optimism. This is particularly relevant when you look at commodity prices. Just over a week ago, Brent crude oil prices had traded as high as almost $140 per barrel, as the market considered the possibility of an EU and US embargo of Russian oil. Since that time, oil prices have fallen dramatically, with the Brent front future now trading closer to $100 a barrel, and the market has embraced this cautious optimism around the possibility of a truce or perhaps a ceasefire. That said, we think there's still reason for caution here. President Putin is fundamentally unpredictable in this crisis, and it's not clear what his ultimate ambitions are. And so we would look for more concrete evidence of a real path toward peace before becoming too optimistic about a decisive near-term solution. As we think about the Ukraine crisis and what that means for global economics and for global markets, central bank decisions have been taking place over the last few sessions, and we've had opportunities to hear from some of the premier central bankers across the G4. So now I'd like to bring in our co-head of global economics and our chief UK economist, Ross Walker, to talk about some of those. I'd like to start with the Bank of England. Ross, we got a bit of a dovish surprise from the Bank of England today. Can you walk us through what they told us and what it means for future monetary policy?
Yeah, so as expected, they delivered the quarter point rise in bank rate to 0.75%. They're ahead of the meeting. Markets have been pricing maybe a 30% probability of a 50 basis point move. And there was certainly an expectation ahead of the meeting that if there was any dovish descent, it would be in a hawkish direction. There would be votes again for a 50 basis point rise. So that never materialized. The one dissenting vote that did was for no change. And although the detail of the minutes conveyed a sense that dovish member, John Cunliffe, he hasn't had so much of a fundamental change of view. It's more that I think he wants more time to assess the outlook, but there's definitely a growing concern about the impact in terms of squeezing real incomes and the effect on demand. So there was a slight dovish pivot, I think, and also in the language, in the guidance, that evolved slightly. Previously, they talked about further modest policy tightening being likely. That has evolved to might be needed. Now, some of this may be just a natural evolution as we get closer to where the BOE is signaling, where at least today it thinks the terminal rate is 1.25% on bank rate. Inevitably, the language would have to evolve. But the fact that came as early as today's meeting, I think, reinforced this sense of a dovish hike.
Certainly from an FX perspective, ahead of this decision, we had been long sterling. We actually took off those positions, turned neutral, thinking that maybe the market was priced either to perfection or maybe a bit too high. And certainly that was the read from the market through the Bank of England this week. But as we know, central banks are not the only game in town. There's also the possibility of fiscal policy. I know there's a spring statement coming up in the UK. Can you talk a little bit about the fiscal outlook in the UK and talk a little bit about what that means maybe for gilt markets?
Yeah, so the fiscal outlook, I think, is similarly complicated and conditional. The good news over the past year is that the UK government deficit data have continued to come in below expectations, lower than expected deficits. Nevertheless, there is, of course, a growing cost of living squeeze. And although higher inflation will support tax revenues, it will also tend to boost some outlays. In particular, I think it's worth noting that of the entire UK government bond stock, a quarter of that, about £500 billion, is index-linked debt. And inflation in the coming year looks like it will be about 3 percentage points higher than what was expected back in the autumn. So automatically, you've got a £15 billion uplift in your debt servicing costs. You've then got a potential public sector wage bill issue to deal with. Higher inflation, of course, means that some public services will need additional cash funding to maintain a real level of output. And of course, we have, with rising energy bills, there's real political pressure for further financial transfers. So we think the outcome of this is really that whatever extra headroom has been created over the past year by these undershooting deficits, a lot of that headroom will be utilized to recycle some financial support back to households, as I say, to service these higher debt servicing costs. So net, yes, the deficits will continue to be coming down, but we think by less than markets expect, and therefore what you maybe have is some upward pressure, at least further out along the curve, and with markets, as we just discussed at the front end, scaling back these rate hike expectations. You've clearly got some interesting curve dynamics going on as well.
So thanks, Ross. I just want to go across the pond briefly from your side to my side to talk a little bit about the U.S. You just mentioned how rate hike expectations are maybe being pulled back as a result of the Bank of England. The Fed this week seemed to push in the opposite direction. Their dot plot, the projection of future potential rate increases, was moved up significantly, and now Fed officials, including the March meeting, looking for 7 rate hikes, the median official, in 2022. Just want to hear your thoughts and perspective on maybe some of the differences, maybe compare and contrast what we heard from the Fed and what we heard from the Bank of England this week.
Yes, it's a dramatic difference. In the sense in the UK, we could be looking at simply 2 more quarter point rate rises, conceivably, whereas the Fed is signaling that it has a long way to go still. The economies are in slightly different cyclical positions, in the sense that the US never had quite the same degree of COVID-related disruption and lockdowns. There certainly wasn't the big lockdown in the first quarter of last year. So spare capacity in the US is clearly less than in the UK. The US is also overlaying what looked like a naturally stronger private sector recovery with a bigger fiscal stimulus, whereas in the UK, from next month, we will be actually seeing some tax rises beginning to hit, in addition to the energy cost shock that we've been talking about. So fiscal policy is clearly less stimulative. And of course, the UK began the tightening cycle a little bit earlier. But even when you take all that into account, if we're talking about a terminal rate in the UK of 1.5%, say, versus something above 3% in the US, that is a dramatic difference, I think, in this relatively low interest rate world. And certainly the change over the next year or two looks like it could be dramatic. And in some ways, that gap feels unsustainable, at least over the medium term. You would expect it to be a bit narrower. But I think it's one of the reasons why we're seeing sterling coming under a little bit more pressure. The rate hike, the positive rate hike story is getting reined in a little bit. The UK growth outlook is being downgraded more than what we're seeing in the US. So there are definitely quite big currency implications here as well.
And certainly part of this story is also the direct or lack of direct exposure for the US, I should say, from Russia's invasion of Ukraine. Certainly that played a role. The Fed was mentioned the invasion in the statement, but it was very clear from the message from the chair being that the US economy is strong enough, the labor market is strong enough, and inflation is frankly so high that they think that they can continue to raise rates in sort of a steady, ongoing way without harming the labor market. So I just want to say thank you very much, Ross, for joining us, and thank you very much for listening.